Market seeing a huge turnaround this afternoon, a neck-snapping 350-plus point swing for the Dow. After the Fed announced it was keeping rates unchanged, gave no indication it would change course, though, on its rate hike. But there were all kinds of dovish comments here. Let us bring in two guys who know what to think of this. Paul Dietrich, Fairfield Global Markets, and Ward McCarthy, Jefferies. He's at Jefferies. He's former Richmond Fed economist. Right away, Ward, I need to get on you about what the market saw that they hated in this report.
Well, it was like the policy statement was like shooting a shotgun because the markets all scrambled in different directions. The equity market, I think, was disappointed because they thought the Fed might signal that they would use the balance sheet to provide support for equities. The oil markets were happy because the Fed was pretty optimistic about the domestic U.S. economy, and the bond market, I think, was somewhat relieved for two reasons. One, because of equities got hit, and two, because they were concerned the Fed might signal that the next rate hike would happen in March.
Yeah, I don't know. What do you think, Paul? When's the next rate hike?
I think the next rate hike won't come until September or December at the latest. I think today's market reaction was literally a vote of no confidence in the Federal Reserve. They made a mistake in raising rates in December. The only reason we ought to be raising rates is because of inflation. We've got deflationary trends coming in the U.S. with oil prices are going to continue to be low through next year. The currency devaluation in China, which means everything 5 months from now and Costco and Walmart is going to be cheaper. And the strong dollar is really hurting earnings.
Okay, well, Ward, though, should the Fed be attached at the hip to what the market is doing? That's the question, because right now we're down 230. Maybe they're spooked to even move.
Well, no, I don't think the Fed should be attached at the hip to what the market is doing. In fact, the Fed spent the last couple of years trying to get the markets off the addiction to QE. And what's happening in the markets these days, I don't think really has anything to do with the Fed. It really is something that has happened because of the confusion and the uncertainty and the volatility in China. So the Fed didn't cause that. They're not going to own up to it, and they're not going to become the balance sheet of last resort for the global financial markets.
Like Genesis, the land of confusion. But, Paul, do you change your investment strategy at all, knowing what we know right now from the Fed's report?
No. Basically, I always tell people you got to make a distinction between the underlying economy and the stock market. And if you look at the underlying economy, I mean, we're in what I call an elephant economy, which it's slow, plodding, but it's forward moving and expanding. And in the history of the United States, we've never had a recession when unemployment is going down, wages are going up, even though 2% last year, housing is going up, and the market's expanding as a whole.
Yeah, we got good new home sales numbers, so we shall see if you are right. Let's hope. It's great to see both of you, Ward McCarthy of Jefferies and Paul Dietrich of Fairfax Global Markets. So nice to have you both.
Thank you.
Okay, we have the Dow.